In 1989, a group of investors won what was, at the time, the largest buyout in the history of Wall Street. They beat the company's own CEO in a 5-week fight that made headlines everywhere. They got the company. They got the brands. They got the trophy every dealmaker on Wall Street wanted. And when they finally sold their stake, years later, they had almost nothing to show for it. Not a small return. Barely any return at all. On the biggest deal anyone had ever attempted. To understand how the winner of the largest buyout in history ended up with almost nothing, you have to understand exactly what they used to win it in the first place. And to understand that, you have to go back to where this whole fight actually started. Inside the company's own boardroom. The company was RJR Nabisco. If those two names don't mean much on their own, the brands inside them will: Oreo, Ritz, Planters, Camel, and Winston cigarettes. All of it sat under one roof. A company built in 1985 when the tobacco giant R.J. Reynolds merged with the food company Nabisco Brands, hoping cookies and crackers could balance out a tobacco business that regulators were closing in on. By 1988, RJR Nabisco was one of the largest industrial companies in the country, something like 140,000 employees. A business so big that almost nobody outside Wall Street thought it could ever change hands quickly, let alone violently. Running it was a man named F. Ross Johnson, and Johnson had already earned a reputation, not for his numbers, but for his lifestyle. RJR Nabisco kept a fleet of roughly 10 corporate jets, unofficially nicknamed the RJR Air Force, parked in a hangar so lavish that people inside the company called it the Taj Mahal. Johnson had spent nearly 2 years trying to lift the company's flagging stock price through ordinary means. Cost cuts, restructuring, the usual playbook. None of it had worked. So in October of 1988, Johnson walked into his own boardroom with a different idea. What if he just bought the company himself? On October 20th, 1988, Johnson proposed taking RJR Nabisco private at $75 a share, about $17 billion, a healthy premium over the stock's price in the mid-$50s. On paper, that looked generous. But buried inside the structure was something else. Johnson and a small group of his executives would put up only about $20 million of their own money in exchange for a stake designed to grow to somewhere around a fifth of the entire company. $20 million for a meaningful slice of a $17 billion company. It's the kind of math that, once people actually saw it, was hard to unsee. Within weeks, Time magazine put Johnson on its cover under a headline that would define the rest of the fight. A game of greed. The board had a decision to make: quietly approve their own CEO's bid to buy the company he ran, or do something else entirely. They chose something else. They made the offer public. And that single decision, opening this up as an auction instead of a private handshake, is what let a total outsider walk through along with his cousin George Roberts. Kravis ran a firm called Kohlberg Kravis Roberts, KKR, and they had spent more than a decade pioneering a very specific kind of deal, the leverage buyout. 6 days after Johnson's proposal, Kravis came in with a bid of his own, around $90 a share, roughly $20.4 billion. Structured so it didn't need Johnson's cooperation at all. For the first time, this fight wasn't just about a CEO buying his own company. It was a battle between an insider who knew the business from the inside out and an outsider who didn't need to know it at all. He just needed to win the auction. What followed was 5 weeks that would become the most notorious bidding war in Wall Street history. At one point, Kravis and Johnson's camps actually tried to team up, agreeing in principle to bid together and split the company. The alliance lasted about a day before it fell apart completely. Neither side could agree on who would actually be in charge. A third player, the investment bank First Boston, jumped in with its own complicated offer, built around a structure meant to defer the enormous tax bill of sale like this would normally trigger. That bid never came together financially, but it kept the auction alive and the price climbing. By early November, the numbers that had opened at $75 and $90 were already pushing past $92, with no sign of slowing down. By December 1st, it came down to one final round. Johnson's group, backed by Shearson Lehman Hutton, came in at $112 a share, cash, plus a package of securities. Kravis and KKR came in at $109 a share, mostly cash. On paper, Johnson's side had won. $3 a share more, across roughly 230 million shares. Hundreds of millions of dollars left on the table. The board took KKR's offer anyway. That decision only makes sense once you understand what was hiding inside Johnson's higher number. A meaningful part of his $112 wasn't cash at all. It was a type of security built around something called a reset feature, a promise that if the securities weren't trading at full value later on, their terms would be adjusted until they were. It sounded reassuring. In practice, it meant a chunk of Johnson's higher bid depended on a promise about the future, not money in hand today. The board looked at that risk and decided that $109 in a more certain package was worth more than $112 wrapped in uncertainty. Even a number that did win wasn't obviously cheap. Years later, two finance professors ran the numbers on KKR's own winning bid and found something striking. For $109 a share, it actually makes sense. RJR Nabisco's cash flow would have needed to grow by at least 18% a year, a rate far above ordinary, healthy growth. KKR hadn't found a bargain. It had made a very expensive bet, which raises the obvious question. If the winning bid already required unusually optimistic assumptions just to make sense, where was the other $25 billion actually going to come from? Here's the part almost nobody watching in 1988 fully understood, and it's the part that makes this story matter today. KKR did not have $25 billion sitting in an account. Nobody does. Instead, roughly 87% of the purchase price, more than $16.7 billion in senior bank loans, plus several billion more in bridge loans that would later be refinanced into high-yield junk bonds, was borrowed. And it wasn't borrowed against KKR's own balance sheet. It was borrowed against RJR Nabisco itself. Its factories, its brands, its future profits, all pledged as collateral for the loans used to buy it. KKR's own cash contribution was somewhere around $1.50 to $2 billion. And even most of that wasn't Kravis and Robert's personal money. It came from KKR's own investors, pension funds, and institutions that had committed capital to the fund. Strip away the layers, and the real picture looks like this. RJR Nabisco was, in a very real sense, bought with its own money. The company's own future earnings were what was actually going to pay off the debt used to acquire it. That idea that a target company's own value can be turned into the weapon used to take it over is the entire mechanism behind a leveraged buyout. RJR Nabisco didn't invent it, but this deal at this size, with this much public drama, is what made the mechanism impossible to ignore. And that debt did not stay quiet for long. RJR Nabisco already had billions of dollars in ordinary investment-grade bonds outstanding, held by pension funds and insurers like Metropolitan Life, who had lent money to what they believed was a stable, conservatively run company. The moment KKR's new debt was layered on top, those existing bonds were suddenly buried under a mountain of high-priority claims. Their value collapsed by more than $100 million. Overnight, through no action of the bondholders. Their argument was simple. Even without an explicit clause forbidding it, RJR Nabisco owed them some basic good faith protection from being leveraged out from under them. A federal court disagreed. The judge ruled that sophisticated lenders who wanted that kind of protection needed to have negotiated it into their contracts up front. And they hadn't. The bondholders lost. But the lesson didn't disappear. The case permanently changed how corporate bonds are written, pushing the market toward new covenants designed to prevent exactly this from happening again. The company itself wasn't spared either. By 1990, less than 2 years after the deal closed, RJR Nabisco was at risk of triggering a default, because part of its new debt included reset notes of its own, the same type of security that had doomed Johnson's bid, now baked into the winning structure. KKR had to step in with roughly $1.7 billion in fresh equity and arrange another $2.25 billion in new loans just to keep the company solvent. Then, in 1993, the debt found its real target. On a day the industry still calls Marlboro Friday, Philip Morris cut the price of Marlboro by roughly 40 cents a pack, fighting to defend its share against cheaper competitors. RJR Nabisco, still carrying about 5 times its old debt load, simply couldn't respond. It didn't have the financial room to cut prices or spend on marketing at the same level. Over the next several years, Philip Morris's market share climbed. RJR slipped, not because its cigarettes were worse, because the company had no margin left to fight with, which brings us back to the winner. By the time KKR finally sold off its remaining stake in the deal, years later, the numbers told an uncomfortable story. Academic research on the outcome, published in the Journal of Economic Perspectives, found that KKR had paid a premium to RJR's original shareholders of roughly $10 billion, and that KKR's own investors were left with an unusually poor return on their money. In plain terms, the firm that won the largest buyout in history ended up handing most of the value it had created straight back to the people it had outbid Ross Johnson to buy from. The company lost. The bondholders lost. And even the side holding the trophy walked away with barely anything to show for it. So who actually won the fight for RJR Nabisco? Ross Johnson didn't. He was pushed out, his own board choosing an outsider over him. But he didn't leave poor, either. His exit package alone was reported at around $53 million, a strange kind of consolation prize for losing control of the company he tried to take for himself. KKR didn't really win either. Not in any way that matched the size of what they'd just done. And RJR Nabisco, the company at the center of it all, spent years absorbing debt that had nothing to do with how well it made cookies or cigarettes, and everything to do with how it had been bought. The one thing that came to the whole ordeal completely intact was the mechanism itself. RJR Nabisco held the record for the largest leveraged buyout in history for almost 2 decades, until even bigger deals and even bigger debt loads eventually broke it. That same basic structure, borrow against a target, hope the cash flow holds, pay yourself first, has been used again and again ever since, right up through deals happening today. The tool that let KKR win the fight for RJR Nabisco is the exact same tool that decided how little would be left once the fight was actually over. That's the part that's easy to miss every time you see a headline about a company being bought for some enormous number. The real question is never just who's paying. It's what they're borrowing against, and how much room is left over once the debt finally comes due.